I would like to introduce panelists. Louise Hedberg, Head of Corporate Governance at East Capital. Then Szymon Orzuk, Head of Polish Equities at Santo Espirito Investment Bank. Sandra Nowakow, Investor Relations Director at Citygate Rogerson. And Tobias, that is Senior Vice President at Aprio. We are going to discuss very up-to-date topic, at least in Poland, after pension fund reform, which is how to attract international investors. And we will review during our panel which segments, market segments, are most successful in attracting investments. Then we will discuss how IROs should adapt their communication to different target audiences. Also, we will see the differences between European-based and US investors. And also, we will review what is expected by international investors in terms of corporate governance practices. So, let me start with the first question about market segments. And we will have an interesting slides. So I would ask the question first to Toby. Which market segments are most successful in attracting investments? And are there any crisis-proof segments?
Thank you for the question. Well, I think we have a slide up in a second. And what we have done as a company, we see basically most of the fund flows in the various regions. So we've broken down the flow of funds for the Polish region, and we try to see, which sectors are important or, most invested in. And we differentiated that from domestic and non-domestic. So what you can see right now is that the financials are the most attractive sector for non-domestic investors as well as domestic investors. And what I thought was worth mentioning is that utilities got an uppick recently from non-domestic investors.
Szymon, would you like to add from your experience as broker?
Well, I can simply add that definitely, financial services and consumer sector attract a lot of attention if it comes to foreign investors. I guess the reason is pretty simple, as the story is easy to understand. Well, there's a significant gap if it comes to consumption per capita, and there is a multiplier inherent in low GDP per capita. So, it's easy to understand, gives exposure to GDP with a multiplier. So consumer and financial services, as I said. Also, markets with strong technology base, they attract a lot of investors. People look for, growth stories. That's why I would say technology. Yeah, and if I can, because you asked about crisis,
yes.
crisis-proof segments. So I would say that this notion is a little bit outdated nowadays. And now the investment landscape can be characterized as the one of low interest rates, sluggish growth, and low expected returns. So people would be looking for, I would rather say, income-yielding securities like dividend stocks, for example.
Okay. Louise, you would like to add something from your perspective, or?
Sure. At East Capital, we've always liked all the typical sectors that have benefited from the development of these markets. We invest in Russia, Eastern Europe, China, and Southeast Asia mainly. And of course, there are lots of consumption stories which are hugely interesting looking at that. The financial sector, naturally, the real estate sector, and certain other things which of course grow naturally with the growing development that these markets are taking. But I would say now I would agree with Shimon that now what's actually taking precedent above that now is the good dividend stories, where we really like the clear, high, and understandable dividend stories out there that we can look into more.
Thank you. So now maybe we can see what are the major differences between US and European investors when it comes to buying and selling decisions. And to that effect, would be interesting to see how IROs are adapting their communication to, or should adapt their communication to different target audiences. Louise, you would like to?
Well, we are originally a Swedish company. We have 26 nationalities working in our company, but our headquarters in Stockholm. So we are, I guess, representing the European side. I don't know what US investors are doing currently, but I mean, we like companies that we understand. We want to know what we own, and in that sense, the IR department has a huge role in explaining what the company does, keeping us up to date of what the company is doing and how things affect the company, and again be clear and transparent over time. And we're very long-term investors, so of course we see this as a partnership. I think the IRO within the company, I know that was discussed in the last session, so together with the management to see it as a partnership as well, that there's a joint common goal and interest in of course seeing increased investor interest and seeing the share price increase. So that should not be a conflict neither in the company nor between the company and its investors, of course. So we like well-behaved companies in every sense. We think it pays off in the long run. We think well-behaved companies are better positioned to create long-term returns. We know that some badly behaved companies can, of course, generate short-term returns, but in the long term, our experience is that well-behaved in every sense is really key to us.
Well, if I can complement this. Well, there are some there is anecdotal evidence, of course, and there are some studies, and well, there are pretty simple differences. I think, from my perspective, U.S. investors are much more are bigger. When you speak with U.S. investors, usually your interlocutor is a person managing portfolios worth billions of dollars. And while you speak with a London-based PM, then you speak with someone managing hundreds of millions of dollars. So it's, I guess it's that's the major difference. In consequence, there is much less investable companies for U.S. investors than for U.S. investors, and simply, liquidity and capitalization thresholds are larger for U.S. investors, and they invest typically in companies with average daily traded value of $5 million. Of course, well, it all varies and differs, but I would say in a general way. Also, some studies show. I've been checking, for the purpose of this panel. Some studies show that U.S. investors might have preference for English-speaking countries. Well, simply familiarity bias, and they might have preference for less developed markets. And it's true that, well, when I was checking with our sales traders, what they see, well, in the bank, what people say is that indeed Americans nowadays are more interested in frontier markets. And also I would say that Americans, they have this US-centric view, so they divide their portfolios like US and non-US. And in non-US part, we might have everything: Europe, Eastern Europe, Asia, LATAM. And it's I used to be a financial analyst, and it was pretty bizarre for me to speak with US PM who, was comparing Polish banks with banks from Korea or banks from Mexico, right? So that was kind of comparisons they were making. While London-based investors, they usually specialize in EMEA region, and they are well informed, and the conversation is much more detailed, much more about stocks rather than about general macro story and then about stocks. Well, I think U.S. investors, they simply, as you know, for them, Eastern Europe is small markets. They require much more education on general issues, on macro story, rather than speaking about companies themselves. And then when you speak about the companies, well, it's kind of general conversation without really going much into details. And then, just to finish, there are studies, I don't know if it's true or not, but well, I found such studies that US investors, they tend to be more value-oriented rather than growth-oriented. From my perspective, I think it's more difficult to engage US investor in a story, but once they are engaged, they are much easier to retain as they're holding periods, the investment horizons, I think, well, again, it's just impression, seems to me to be a little bit longer.
Just to add to that, in terms of preparation and in terms of adapting your approach, I mean, whilst certainly German or Austrian investors might have less trouble locating Poland or other CEE countries on the map, I think it's important to look at each investor on a case-by-case basis, because whilst there are generalizations, there are certainly more and more sophisticated emerging markets investors across the globe. So you might have a US investor who is very well acquainted with the macro picture and with some of your peer group in CEE and across Europe. So we would urge companies out there to engage with investors prior to meeting them with the management team, find out exactly what their interest areas are, what their knowledge levels are, what they require from a meeting, so that when you do meet them, you make the most of your time, you prepare exactly the information that they'd like to see, or that you bring along perhaps a business head, a divisional management that they would like specific comments from.
Toby has prepared another interesting slides to show you differences between different style of investment. If you could comment.
Well, to cut a long story short, basically, if you look at this slide and the prior slide, if you are financial services and you're a growth story, you're well off and you can stop listening. No, I'm joking. Well, I think it shows quite nicely the difference that domestic investors very much focus on growth and value, whereas the non-domestic investors are more spread. And I guess that is also a little bit based on the data that is available, but the index makes a huge impact. We looked at it at a different angle, and about 1/3 of the money here, non-domestic investment in Poland, is based on index funds, so something where you don't actually have a choice, it's just happening by definition. So that's definitely something to bear in mind when you go on the road, to make sure that you're not meeting passive investors that might hold a huge position in your stock, but since they are passive, they will only react to different triggers instead of making an active buying and selling decision. And if you allow me one comment on the prior question, is something that I have seen over the last 15 years is that US investors, and that's open for debate, but that's my sort of 2 cents on this. US investors like to see senior management. They are more keen on meeting the people that actually run the company they invest in. They want to look them in the eyes, and then as an additional source of information, not just on the numbers they're looking at, but also what kind of a guy is that, and does he know what he's talking about? So your suggestion, Sandra, of bringing divisional heads along to the meetings has been perceived very well. not only by U.S. investors but by European investors as well. And I think it's great. And I know a lot of companies that do that on a regular basis and have made where they said that's really helpful to the discussion, and it also gives a bit of personal touch to those meetings and adds to I mean, at the end of the day, it's still a people's business.
Sandra, would you like to add some more about how IROs should adapt their communication program to different target audiences? Are there any other differences or?
No, I think our view is very much that you look at it on a case-by-case basis. So you address the needs of each specific investor rather than looking at some of the regional trends and some of the generalizations. So in terms of preparing all the information materials, in terms of the Q&A documents that are prepared internally ahead of any communication, and in terms of who you bring along to a meeting, we very much recommend that this is adapted to each fund manager or buy-side analyst needs.
And I think it's fair to say that Americans are a little bit more straightforward than British.
Yes. Okay, so let's move to corporate governance. And I'm looking at Louise. What are the most important corporate governance practices assessed by investors when analyzing a company? Could you give us 3 or 4 main points?
Sure. I mean, what we always look at, first of all, is shareholder structure and the board and the management team. Who are these 3 groups? What are the individual goals of these 3 constituencies? And are their targets and ideas aligned with ours as investors? And I think from that you can derive a lot of different corporate governance related risks, but also opportunities. Of course, we expect transparency. We like quarterly IFRS reporting. We like good and clear websites in both local language and in English that are updated simultaneously and are equally information rich in both versions. Not all our fund managers and analysts speak all 30 languages that we cover. So of course, even though we speak a lot of local languages, we're not, we do depend on the English website as well. We like definitely to size up the management team, look them deeply in the eye and figure out, is this a team that we want to entrust our money with? I mean, we have clients, 500,000 clients all over the world. Many of them are old people who put their money with us. So of course it's part of our duty and part of our strategy to understand, is this a company that will be a good investment or not? So we really must be able to meet our clients in turn and say why we picked one or other company and why we were convinced that that company would add value to our funds. So I think a lot can be said from shareholder structure. I urge everyone to be as transparent as possible in that sense and be very clear with, if you have a majority shareholder, what the actual ultimate goal of that majority shareholder is. And if there is one in our case, we want to make sure that our interests are aligned. And one way of doing that is dividend policy. Looking at the dividend policy, do we feel that profits are shared in a way which is recurring over time and which is reasonable and understandable given the company's position, age, etc. And I think that tells us a lot about who we're going into business with. And I can be very frank and say it doesn't always hold these analytical methods, but I think all in all we can say that governance in general in this investment region has improved hugely, and I think it's great to see that the number of really professional teams that we see out there. And from an IRO perspective, I think you should remember that it's also important to really market the equity story. I think we urge all companies to really get out there and get investors interested. I mean, we will be interested to listen to your story in any case because you're part of our region. But looking internationally, I think this region is not always that great at selling its story. So I think you can spend some time, working on the excitement of the individual equity stories.
Thank you. So let's suppose that we are all of you represent companies that have perfect corporate governance practices. Now, what do you think? What other key factors can encourage potential investors to invest in a company, such as liquidity or capitalization? Shimon, if you could tell us from investor also point of view, what other factors are key?
Yeah, well, I guess that the answer is pretty simple. Well, you need to provide growth, generate excess cash flow, have strong balance sheet, be liquid, and ideally investors would like to buy you at single-digit P's, right? So it's kind of joking a little bit. But being more serious, again, I would make a distinction between foreign and local. So well, there are pretty obvious things that I guess that foreigners, they have strong preference for large capitalization, liquidity, stocks that are widely held, and of course that have strong corporate governance policies. And well, it's hard to engage investors when your market cap is lower than 1 billion. Of course, there are exceptions because there are interesting smaller companies. But well, speaking in a general way, then of course the membership in indices like MSCI matters a lot. So foreigners, they tend to look at these stocks. They simply benchmark against these indices, while domestic investors, they don't care that much, and they tend to overweight stocks that are not members of global indices. But I think the most important element is for investors to find some sort of competitive edge that enable the company to generate extra returns above cost of capital, and they need to understand properly where does it come from, where the company sits in terms of market, in terms of value chain, what is its market position. They simply need to understand the sources and sustainability of this competitive advantage. And all this has to be, well, especially for foreigners, but also recently, at least in Poland, for local investors, all this has to be put in cross-border competitive context rather than just local context, because investors, global investors, they have plenty of opportunities elsewhere. They don't have to invest in a particular country. And well, as a consequence of this strong preference for cash generative business model, people nowadays, I think, they tend to look at measures like sustainable ROE, at metrics like cash flow return on investment, cash return on capital invested. So I think, well, what really matters is the ability to generate cash flow and to be able to distribute cash to dividends, or to be able to grow, to invest and to provide growth rates. Well, I guess this is. Let me see if I noted anything else. No, this is it.
Yeah, Louise, you would like to add?
Yeah, apart from the factors that I mentioned before, I mean, clearly demonstrating that this company is out to create shareholder value every single day, and not just for one shareholder, but for all shareholders equally. We also understand, along with the rest of the investors of the world, that the companies need to understand material and relevant challenges and opportunity related to sustainability issues. So that is environmental issues and other social issues, health and safety, labor rights, etc. So when I said well managed in every sense, this includes understanding which challenges and factors are relevant to your business, communicating a strategy, how you are managing that issue, and also trying to exemplify and demonstrate why your company is better positioned than your peers, perhaps even, to live with these new developments. There's regulation, there's cost for emissions, there's cost for accidents. All these things are now very clear to the investment community, are part of the fundamentals that we need to assess.
Just to add, I think, Louise, you mentioned some of the communication aspects in terms of communicating the strategy. I think a lot of what Shimon was talking about is outside of IRO's control in terms of the fundamentals and the performance. But what you can do as head of investor relations is make sure that you are out there, that you are proactive, that you're reaching out to the sell side, the buy sides, and making sure that all the positive things that you are able to talk about are put out there in the market, and that you get the management board on side, that you take them out to see investors, that you're open, transparent, and straightforward when answering questions. So from a communications point of view, there is a lot that can be done, provided that you have a mix of the fundamentals and the performance that certain types of investors are looking for.
I'm absolutely with you, Sandra, and I think life would be too easy if every company could tick every box. Then it probably wouldn't take the role of an IRO. So unfortunately, it isn't always that easy. And what I've seen in talking with many companies is that a lot of companies do not really prepare when they go to a meeting to the extent what the investor is looking for. So they come with their numbers, they know all the story, this is all fine, but at the end of the day, they do very little or even sometimes no research on what the investor is looking for. So what kind, not just what kind of type of investor that is he a growth investor or a GARP investor or whatever, but also, in his portfolio, if you screen the portfolio, what do the fundamentals look like that he typically invests in? That is less relevant whether that matches up with your peers or not. But, if he is interested in a, strong PE ratio or this or that, it's good if you know that beforehand, because then you can steer the meeting in that direction. Whereas, if you just sit there and tell your story and you don't relate to anything that matters to him, it's probably going to be a tougher sell at the end of the day. Now, when you said you're looking at the shareholder structure, the other day I got a call from a well, it used to be a prospect, now it's a client, who said he walked with his CFO into a meeting and they basically asked, okay, how many shares do you hold of our company? And the fund manager got up and said, well, do your homework. If you don't know that we are a major shareholder of yours, for his respect, it was under 1%, but still, it was significant. He said, if you don't know that and you want my time, I'm not prepared to give it to you. Go home, do your homework, find out what we want, and then come back again. Obviously, the IRO wasn't really pleased with that meeting. He said it was the most embarrassing meeting he've ever had. But
we would
but
probably
it shows
be nicer.
Sorry?
We would probably be more polite, but probably
it was an American investor.
Thinking the same thing. Yes.
Was an American investor. So no, cut a long story short, there's also homework to be done to see whom am I meeting and what is the guy's interest and how does he invest. I'm sure you are different to a lot of other people out there. Everybody is different, right?
I would like to ask a question, because we have corporate governance practices in everyday life, and then suddenly company has a crisis. So my question is crisis an opportunity for a company, and how behavior of company in crisis management influences investment decisions? Louise?
Well, a crisis is really only a crisis until it's been mismanaged. It's a serious event which turns into a crisis because you've not handled it correctly, right? So it's all up to how you manage it. Anyone can end up in a terrible situation, an accident, financial, boom, bust, whatever. It's all about how you manage it, of course, on a management level, but how you communicate about it. And I think companies can definitely come out stronger if you manage it right. I think it's all about what brought along the crisis, how did you manage it the first few days, the weeks. I would not advise trying to cover anything up. It all surfaces anyway, sooner or later, and that will take a lot more time and effort to repair than the crisis itself. So I think there's of course, this is not something you wish upon anything, not definitely not the company in a portfolio that you're running. But if it does happen and you're a long-term investor, of course you will continue to lend support to a company that is doing its very best to manage that.
Toby?
Yeah, I think that's it's all about communication and well, if you've built trust beforehand, you know, don't start. Well, I'd say two things. One, don't start communicating if things are going well, and don't start communicating if things are going bad. Both is probably not the right thing. You have to continuously communicate with the market. You have to build the trust. I've once spoken to an IRO who said, like, people trust me. I can push the price of our stock 10% if I want to, if I tell investors the story, but it wouldn't last very long, and then I could never ever go back. So it's very important to have be fair, open, transparent, and as you said, you know, sometimes happens, and well, then you better sort it out instead of covering it up. That just makes it worse.
Thank you. So we've been talking about investors, what they are looking for. Now I would like to ask question to Sandra, because recently I've seen IR survey made by Citygate Due Rogerson among 190 IR managers in European companies. So Sandra, what are the latest trends in IR programs?
Well, I'll try to keep this brief. I think we all touched upon the quality of sell-side coverage, so I won't dwell on this, but this is obviously going down. And what's encouraging is to see that 42% of companies this year have noticed an increase in internal buy-side research. So it looks like investors are doing a lot more homework and picking up the slack from any of and sort of covering gaps in sell-side coverage. What's also encouraging is that activity levels are certainly going up across Europe. The majority of companies are planning to do more than they have done last year. There's a lot of focus on potential investors. A lot of European companies are paying a lot more attention to Asia. A lot more so than last year. So they are trying out various financial centers in terms of roadshow activity across Asia. Some are even setting up IR presence in the continent. So I don't think they expect immediate effects, but there's certainly efforts and sort of more long-term education that has started to happen. Another thing that we have picked up on is that companies are trying to get greater returns on everything they do. So trying to make everything as relevant as possible, be it this in terms of disclosure and reporting, or the KPIs that they use when they provide guidance to the market. But also it comes back to targeting and roadshow activity. So companies taking a lot more control of the targets that are set for roadshow meetings, and you know, we've certainly seen a lot of queries from existing and potential clients with respect to how we can help in terms of additional analysis. So whilst a lot of companies are still using brokers to set up all the meetings, they're certainly questioning all the targets that are put forward, or supplying a large number of targets themselves. On top of that, companies are on the roads and doing more and more independent roadshows, so setting their own meetings up or using external advisors outside of the sort of broker activity. And within that, IROs are going out on the road to meet potential investors or to keep some investors up to date in between the meetings with the management, so that when they bring the senior management team along, that they have brief the investors so that the quality of the meetings is as good as it can be. What we've also seen in terms of trends is technology affecting all aspects of investor relations, and where there was a lot of debate over the recent years over social media and to what extent that is helpful, or what in terms of concerns that people have had when it comes to compliance and controls. Now, I think the debate has gone slightly beyond that now, and we are seeing a lot more video content being put up on websites, a lot of events becoming more interactive, people reaching out to investors using video conferencing. And I've seen statistics somewhere that video conferencing now makes up 15% of roadshow meetings. So be it bringing in divisional managers for specific meetings, so video conferencing them in when they're not traveling for the full 2 or 3 or 5 days with the rest of the team, or using online platforms for corporate access, which we're seeing, both when it comes to brokers, but also there's so much development in this area that I think the increasingly solutions being put out there for corporates as well. And then coming down to online feedback tools, CSR platforms. So I think technology is starting to play an increasing role in terms of increasing efficiency, increasing returns on all the communications initiatives.
Thank you. And Toby, have you seen changes in clients' needs in the recent years, 5 years ago and now? What the corporates are looking for?
Well, I think that's very much along the line what you just said, Sandra. The whole going on the road and speaking with investors, the way to communicate has become, multi-channel. It's not just the quarterly conference calls, videos, or whatever. So yeah, there is definitely a demand for and the use of new technologies. Be it a database like ours, where investors can screen exactly whom to see and make it a match when they go out on the road. I always like to compare that a bit like if you are the first time in, say, Stockholm, for argument's sake, and you want to have a dinner, you wouldn't just go into the next shop and have dinner and then find out probably it wasn't the best place to go to. You would check out on, be it TripAdvisor or something like that. You would see, okay, this is the kind of food that I like. Where is the best shop based on numerous information, and go there. And that's a bit like what I see, or what we've seen over the last couple of years from investor relations officers. They get a lot more picky on what the brokers suggest, and they seek that information themselves. I don't know, Sandra, do you have statistics or any numbers how much a day of roadshow is, all costs included, preparation, everything?
Ooh, I'm afraid I don't have that with me, but what I do know in terms of statistics when it comes to targeting is that more than 40% of companies who responded to our survey this year said that they set the majority of their roadshow targets, which we thought was quite a surprising number, given that they all still claim to be using brokers for most of the meetings. So it sounds like...
So the question is how they picked them, on which basis, I hear it very often that they say, okay, well, give me all the companies that are invested, or the investment institutions that are invested in my peers, but not me, and I will go and see them. And we've seen on a couple of statistics that actually it's not so much the peers that trigger the investment, it's more the fundamentals that trigger the investment. If I'm not mistaken, that's exactly what you just said. Like, you want to see money and not banks. This is what it comes down to. And so I've heard statistics, and I just want to check them with you. I'm not sure whether they're true, but 1 day of roadshow of a large cap is approximately 80,000 euros a day, which includes all the preparation, flight, hotel. A large factor is the salary of the people traveling, and it's 3 people traveling, so it adds up. And if you compare that, if you just sort of avoid 2 days on the road a year of wasted meetings, you've saved a lot of money. You can hire an additional head, or buy our database or whatever. You know, there's a lot of money to be saved. Plus, you have higher quality meetings, and probably that adds to the openness of senior management to go traveling if they find that the meetings that have been set up are meaningful to them and they get good feedback. So to answer your question, yes, there is definitely a bigger demand for supporting technologies. There is a higher demand for video conferencing because people, you know, on the one hand side, they need to deliver the sustainability. On the other hand, they waste a lot of carbon monoxide or whatever on planes, so they rather do the video conference. And that would be a question, if I may ask a question, a question to you, Louise. Are you open to these kind of meetings over video conferencing, or do you have a preference even?
No, I mean we cover so much territory. I don't even know how many time zones there are in Russia nowadays. But it's of course a huge geographic territory. We're 120 people total, not just investment professionals. So of course we appreciate all of these things, not least because schedules collide and you want to catch up on something afterwards, or you can't sit the full hour because you have to do 3 other parallel things, and you want to catch the end to later. So I think, no, definitely, and regular phone conferences or webcasts after every quarterly report, that's just something that should be part of the everyday, annual calendar of any listed company. And of course, we're looking to that. And a country like Turkey, who's the first country in the world to make AGMs on the internet mandatory for listed companies. I mean, that's fantastic. That's not even available in Sweden. You're not allowed to webcast anything from an AGM in Sweden. And you have to go there in person. And we vote for 50% of our portfolio, which means that we can, of course, not go to all these meetings. So that's a great, new step. And it's interactive as well and multilingual. So, I mean, I think more countries could go that way as well.
And Louise, what about site visits? Would you visit a company
yes,
in virtual world, or you prefer to go and see?
No, of course. I mean, company visits are our, favorite topic. I mean, group meetings are of course valuable, but sitting down alone and going to see the companies, especially in their hometowns and in their factories, and checking out the products and tasting the whatever things they produce, or seeing the steel mill, whatever, it makes a huge difference. And it also allows you to compare between different companies. They did it like this, and this company does it like that. Why is that? And it makes it much more intuitive, and that's something you can never get through any financial reporting. And I must say, a lot of companies are very good at producing very many pages, but looking at the pages, not that many pages are that important when it comes down to it. So, go home, ask yourselves what is material, what is relevant, and that is what you want to focus the communication on to really help and guide the investors, and not hide it in a lot of other things. So that's also, it's a difficult exercise, but it's really about challenging yourself to what you should communicate.
And I have, regarding new technologies, additional question. We've done together with AIMO Global, it's an international network of financial PR agencies. We've done research among fund managers to ask if they use social media as a source of information for their professional objectives, and 80% said no. So what is your view? How would you believe what is written in social media about the company? Is it your source of information? Or if you use social media, when?
I mean, I think some of our fund managers do follow some company pages on Facebook, and of course, and they may draw some anecdotal conclusions from that, but of course it's not the main source. I think what we do twice per year is screen all our portfolios for allegations of breaching any of these international conventions and norms related to corruption, related to environment, etc. And those screenings are based on 30 or 40 or 50,000 sources, which I can only assume, I don't think we're quite there yet, will come more from these social media, because that's a cheap and and open platform for information where NGOs, where employees, where other people may be feeding out negative stuff about the company. So of course you should monitor that carefully and be able to respond to questions related to that.
I think from a company perspective, we've seen the same thing in terms of usage of social media, that it's mainly monitoring and alerts, so monitoring exactly for the reasons you mentioned. And in terms of proactive communication, it still tends to be alerting the market to news announcement results, or tweeting during an event just with some of the headline news that are being announced. So in terms of CEOs or any members of the management team or IR writing blogs and engaging at that level, we think that this still happens in a very limited amount, and that people are still concerned about compliance and risk issues and professional etiquette. So monitoring and alerts seems to be what these channels are used most for, from our experience.
Maybe just one sentence. I know a firm which is successfully selling research based purely on social media to investors in UK.
Yes, but the fact that investors don't look at social media every day as a source of information, I just wanted to add that media and journalists look at the social media and they find stories there. So it's always worth to control what is about your companies in social media, because even if investors are not so eager to use them, media are using, and then we can have crisis suddenly.
No, I think there's so much information out there, and if this is an additional channel, that's fine. I think it just needs to be professional and follow all the other rules as any other channel. I mean, we're happy to go there too. I think it's just a matter of relevance.
So we are coming to the end, and I have a little bit different question. I would like to have your view on responsible shareholder engagement. We were talking about corporate governance in companies. Now let's talk a little bit about shareholders. And should investors engage actively in the company they own, exercise their rights diligently, take rational decisions? And another question is, can institutions afford to be active shareholders? And what conditions must be fulfilled to help them to become active shareholders? So first, my question goes to Louise, of course.
Yeah, well, I guess if you're not passive, which sometimes seems a much easier job than being active, you're active. And in being active, you should try and do the best with the money. I told you about the 500,000 people who have their money with us. And if we feel that there is an issue that should be addressed or could be addressed, and perhaps encourage the company to address those issues, which will help create value in the long term, of course it's in our interest to try and initiate that type of dialogue or engagement with the company. We vote for approximately 50% of the value of our portfolios. We, in Russia, nominate and elect about 20 board members. In the Balkans, an additional 10. In the Baltics, a couple as well. And we're happy we don't ever take board positions ourselves because that puts us in an insider position, but we're happy to nominate good, strategic, intelligent people to the boards who are clearly independent and clearly there to create value for everyone. So that's one way of clearly being active. And if something goes wrong, we're also happy to go to court if we have to, if we think that there's a value that we must defend for the funds that we run. We don't do it that often. Often we're able to solve things through dialogue, but we do find ourselves in court sometimes. And I've been in constitutional court in Latvia, and now we're processing in the Cayman Islands. So we are definitely extremely active. And on the flip side of that, we're also more and more asked by companies to provide us with feedback, which is extremely both interesting and encouraging, and something we truly welcome. We were asked by one large Russian company to provide input on how to structure their incentive program to the management and the board. And of course, we're happy to feed in that type of feedback as well. And I think it's a natural part of capital markets that we source the best ideas and really try and capitalize on those that we think will create value. So that's also very, very good to see.
Well, I think it's pretty obvious. It's fiduciary duty to be engaged as an investor. And well, for example, already 10 years ago when I was PM at ING, the biggest pension fund in Poland, we were pioneer in implementing this type of procedures. We created the position of corporate governance officer, and it took, I think, roughly 20% of each analyst or PM time to be actively involved in this type of activities. Yes, I think the answer is pretty obvious.
Just to address the conditions that must be fulfilled to help investors become more active, I think, I mean, a lot of the companies are very active and engaged, and they are trying to encourage their investors to do their part. However, in looking at some of the areas such as executive remuneration, we find that nearly half of the IR teams don't communicate with their investors when it comes to remuneration. They leave it to the remuneration committee or the company secretary or someone else within the company. And for our audience here, I think that's an opportunity missed, because if you are talking to your investors about everything else, then you should take control of that dialogue. And yes, you might need support and cooperation with different parts of the company, but we think that at an IR team or IRO level, there shouldn't be any shying away from questions that our companies are clearly still finding difficult.
Yeah, and I think it's for example, we do a lot of perception studies where we often get the feedback before we even start the actual interview that the people we call say, all right, it's actually very interesting that the company wants to know what I think about them. Nobody ever asked me for the last 10 years. I have a story to tell, and it's much better if you get that feedback through a perception study instead of during the annual meeting where, the bomb explodes and then all of a sudden, you are really in trouble as a company. So I guess at the end of the day, it all comes back to communication in good times and in bad times. And asking the opinion and staying in a constant dialogue, know who your shareholders are and talk to them. And if you don't do that, you're bound for trouble. And then you have these companies complaining about activists during their annual meeting. My personal opinion is that something went wrong before that and not at the annual meeting where it sort of escalates. A lot of things, I mean, at the end of the day, at some point the investor made a decision to invest in that company because he believed in that company. Otherwise, he would not have spent his money. So at some point, it turned where all of a sudden he does not believe in something, and if the communication isn't flowing, then you are in trouble. So I personally think active investors is a good thing, and it's me as a sort of client of yours investing in your funds, I would expect that from you. I do expect that from you, that you defend my right to increase the money. It's a natural thing, and I think you take it very serious. Yeah.
Thank you. So we come to the conclusion that investor relation is really two-direction communication, and the role of IR is not just throw information at investors, but also to get feedback from them and react, which I think is the final conclusion. And now we have 5 minutes. A little bit, 3 minutes for Louise for
speaking of two-way communications.
For questions.
Two-way communications. Does anyone have a question for our panel? Peter?
Thank you, panel, for a super interesting discussion. Just really one question about what does a good investor meeting look like? And what does a bad investor meeting look like? To all of you, I guess.
Well, if I may start, I think a bad investor meeting is sitting across the table from someone who isn't informed about the company, or someone who is not your natural target, or getting a meeting with a person that might be too junior, unable to make decisions. So if you've got your senior management team, you want to have a constructive meeting. You want to have tangible results. If not, in the short term, then certainly in the longer term. And if that meeting doesn't get the ball rolling in that respect, and then that's certainly a waste of time and a bad meeting. And we've heard about the costs of management time on top of all the travel costs. So you want results. A good meeting is obviously the opposite. So you deliver what the fund manager or the buy-side analyst would like to hear. You bring along the person that they'd like to meet. You answer the questions openly. You provide as much disclosure as you can without being selective. And with any of the things that you can't disclose, you are very open about these things, and you set the rules. So I think in our view, those are the key points.
Luis, you want to? Okay. Any other question? There was one, yeah.
Thank you very much. I have a question. Maybe to you, Luis. It's very good to see you again at another conference. The question is that I didn't ask last time, so now a good opportunity to ask you. You mentioned that East Capital, for instance, is a very good example with strong ESG departments, which you had, and that you definitely don't ignore shareholders' meetings, at least the annual one, where you vote. The question is how companies can get information the way the funds voted, because I'm not sure if the depository bank provided information. We get information who was voting, that's fine, but I don't get information who voted and what's the split against, or supported there.
Is that a DR program that you don't
Yes,
get the
that's
split
correct.
for? I
That's
don't know how they work, because we have a lot of trouble with DRs anyway, because we sometimes want to go to the meeting and we won't be allowed since we're part of this DR community. So there I can only urge companies that have DR programs where investors want to come anyway. They're obviously an investor but can't, perhaps issue a POA because it's part of the DR program, to invite them as guests, because sometimes we just want to hear the discussion at the meeting and we'll vote anyway through the system. I don't know how to get that in hard numbers. If you have a good contact with the company, you can always ask them, and I guess it's up to them to let you know how they vote anyway. And I think in most cases, unless it's some specific issue, we would maybe tell you how we voted, because it's part of feedbacking to you, and also building the partnership, which I mentioned earlier. But the DR thing is difficult because we're in the hands of other stakeholders of the market.
Thank you. Luis, do you give information to proxy solicitors?
Well, typically I think it's good if you have proxy solicitor services in there trying to engage people to vote. So I appreciate that you actually have those. We do, unless it's some sort of specific reason not to. So, and it's maybe a bit up to the time of our time management of our middle office, who cannot really manage all the requests sometimes. So. But
so
typically we are visible as shareholders. We don't hide naturally behind different custodians. So unless we're part of a DR program, we're there with our own name. Okay, I need to run. But it was great meeting you. And if there are any other questions, feel free to email me. I think there are contacts on our websites. Otherwise, I think Candice can be happy to forward my contacts as well.
No problem.
Thank you very much.
Thank you, Louise. Thank you to our panel. Louise from East Capital, Sandra from Citygate, Simone from Espirito Santo, and Patrick Tobias from Aprio.
One comment, if I may. If anybody's interested in this study, Fund of Flows, if you give me your business card, I'm happy to email it to you.
Okay, so now I think we've all deserved a drink. Please help yourself at the bar, and in about 5 minutes, we'll start our little award ceremony.